Over the years, buy-to-let property has become the default choice for people who don't want to see their cash lazing around in low-interest savings accounts. But if you think the buy-to-let market today can provide the same easy earnings as it did just 10 years ago, you're in for a very nasty financial surprise. There's no denying that back in the 90s and even the noughties, buying a residential property and letting it out had its financial merits. Providing you were in it for the long run and were able to weather the occasional crash, there was a good chance of some half-decent returns. The banks were doing their bit to fuel the buy-to-let investment bubble by lending money to anyone that could write their name on a piece of paper. Lending limits on buy-to-let property had no bearing on what you could afford financially. You just had to say in your mortgage application that you were confident the rental yield would cover the mortgage interest. In no time at all, and regardless of your financial situation, you could build your very own property portfolio. But that's now all changed. The financial crash of 2008 meant that banks, reeling off the back of their own greed, no longer wanted to lend and dropped the loan-to-value ratio on mortgages in some cases down to just 45%, and some even stopped lending altogether. The market was dealt a further blow in 2014 when new lending rules were introduced. This means that both residential and buy-to-let borrowers now have to prove they can actually afford to pay their mortgage. I wonder who came up with that genius idea. It says a lot about their attitude that this simple concept never even occurred to the banks prior to the financial crisis. George Osborne's personal vendetta against private landlords has really tightened the screw on potential buy-to-let investors in an effort to find favour with first-time buyers frozen out of the market by rising prices. First, there was a series of stamp duty hikes on the higher end of the property market. Then in April of this year, stamp duty on second homes was increased, adding an additional 3% of the property value to your purchase price. And remember, that's in addition to the stamp duty that you're already paying. Worse still, when you come to sell the property in the years ahead, you'll pay even further through a higher rate of capital gains tax than gets applied to any other type of investment. Then came the infamous Section 24, where Osborne progressively removed the setting off of higher rate tax against mortgage costs for private landlords. The legal challenge against these changes failed recently, so it looks like the financially illiterate Mr. Osborne will leave a permanent legacy as the first Conservative Chancellor to make it a crime to own investment property in the UK. But let's say you're still tempted to opt for buy-to-let property. The market is saturated with the traditional entry point in this area, the two-bed, new-build, off-plan apartment. There are hundreds standing empty in parts of London, so you'll be hard-pushed to make this strategy work. Then you'll need to decide whether you're prepared to actively manage the property yourself. It might save you money, but do you really want to get a phone call at 2 o'clock on a winter's morning to go and deal with that burst water pipe? I thought not. That means you'll need to factor in the cost of a management agency, and they'll be skimming off a healthy 10 to 15% of your monthly rental yield before it even hits your bank account. And that's before they start billing you for any repairs and maintenance work. So if you still like the idea of a bricks and mortar investment, what's the answer? Well, houses of multiple occupation, or HMOs, are one alternative, offering higher yields for a given size of property, as tenants have their own bedroom and then share the common parts. These have moved on from the grotty student bedsits of the 70s and 80s and have worked particularly well among young professionals brought up on programs like Friends. Commercial property can also offer great benefits like long-term passive income and hands-free investment. If you read our Wealth Watch magazine or you've visited our website recently, you'll see we have a range of great commercial property investments from care homes to theme parks. And provided you stick below the £150,000 investment threshold, there's no stamp duty to pay. And you'll even qualify for a lower rate of capital gains tax when you sell the property. Elite Investor Club regular Harry Dent says you should use the monopoly approach when it comes to property and invest for income rather than capital gain. Commercial property investment gives you an ideal opportunity to do that, and many have built-in uplift to the original investment when you sell them back. With the Mayor of London recently launching the biggest and most comprehensive inquiry into the effect of overseas investment in the residential sector, you can expect the buy-to-let market to become more challenging than ever. So if you're still set on investing in the residential buy-to-let market as a strategy for wealth creation, be very careful out there. Even with today's modern technology, gold is incredibly difficult to find. In total, just 160,000 tons of gold are in circulation across the world.